You can actually watch on an intraday basis how every uptick in the dollar, you'll see the opposite occurring in the Bitcoin chart or in the stock charts of the S&P as well. So a lot has to do with the dollar. We have to keep an eye on rates. Remember, as interest rates rise, there are going to be a certain amount of investors that say, hey, listen, I could get kind of a risk-free return of 5% or 4%. Why am I risking my money in Bitcoin or in the stock market when I could lose 20 or 30%? So there's this give and take going on in the market as the market tries to gauge what the heck the Federal Reserve is going to do in this coming meeting. Are they going to raise 75? Is it going to be 50? Is it going to be 100? And again, the market is just trying to figure. So you're right on that. So we have Bitcoin that flushed early today with the stock market. The stock market was down sharply this morning. It reversed because the dollar began to pull back. And amazingly, I mean, gold was down this morning, and then gold reversed basically flat on the day as the dollar came in. And you can see Bitcoin rallying up as well. So the key for me is continuing to watch this 19,500 level on a daily closing basis. The reason why that's such an important level to me is if you go all the way back to the 2017 high, that is the high pivot. And that's kind of the level we've been dancing around for a long, long time. So as long as we kind of hover around that level, there's a small chance that Bitcoin can get some sort of bid if the dollar comes in, if the Fed gives some sort of dovish speak on Wednesday that maybe shows a pivot coming for interest rates. So here it is. And what you could see is basically they're following almost in tune with each other. And I think this is so remarkable because, gold, we've grown up, for the past 20, 40, 60 years that gold was a safety play when things got scary in risk assets. But we can clearly see that's not the case here with gold and the S&P both dipping as Bitcoin has also dipped. And again, the charts are very, very similar in terms of their price action. And again, the key here is understanding that it's the dollar that is causing the movement in both gold as well as risk assets like the stock market and cryptocurrency. I think gold has been doing amazingly well. Number one, if any investor out there was fully in gold, they would be thrilled this year, right? I mean, they would be so happy to only be down 5% or so on the year. And the other thing to remember is the gold chart is only down 5, give or take a percent, but the dollar has gone up 15% on the year. So if someone told me that the dollar was going to rise 15%,
Yeah.
I would say, oh, well, gold probably should be down 15% on the year at
Right.
least. And the fact is, it's only down 5%, which shows to me it's relatively outperforming what it should be doing. And it tells me to also that you likely are having smart money accumulating, which is why it's not down as much. So I continue to be a huge bull on gold. I think, again, people love to hate on gold, but in reality, it's performed well. I mean, take a look at the euro chart, the gold euro chart, or the gold yen chart. It's an awesome. If you were in those assets via those currencies, you'd be loving gold even more this year. But I think, again, the fact that gold is holding up as well as it is with such a strong dollar is a testament that it's getting ready for a big bull run. I think Bitcoin still has another leg lower to 12 to 13,000. I think the stock market likely by end of year or early 2023 will tag the March 2020, well, the highs just before the March 2020 COVID collapse. So you're talking about the S&P downside to like 3,400 or so. The key for gold's outperformance is going to be when you hear the Fed pivot. The Fed pivot is going to be key because inflation's not going to be down to 2% or under, and it's going to tell you that the Fed is now more worried about the economy than about inflation. The market is trying to price in how much more hikes they're going to do in terms of interest rates, how much tighter the dollar is going to be, the supply of the dollar. And what the market wants to see is it start to curl down, where instead of a 75 basis point hike after this next meeting, maybe they do 50 or 25, or maybe they go on hold. And what that's going to assume, that the investing public is going to assume that that means they're going to go to zero. And then eventually when the economy gets into a bad recession, they're going to start going back to quantitative easing again down the line. Now, it's not for a long,
Right.
long time, but you absolutely will see that again when the economy starts to really tank.